One thing that can help you greatly when you're doing a 1031 exchange is having certain pieces of information, because that information really helps you make better decisions. And one of those data points is, what is the gain on your sale if you do not do a 1031 exchange? And what is the subsequent tax that you would have to pay? Understanding that amount can really be helpful. So how do you calculate gain? It can be kind of confusing because, again, it's tax rules. So the first thing I want to do is eliminate a couple items. The amount of debt that you have on a property or the amount of cash that you're generating from your sale have nothing to do with your gain. Those two items should never be used or discussed when you're calculating the gain on your property. So again, forget the debt, forget the amount of cash. What you look to first is, what did you pay for the property originally? Let's say you bought a property 10 years ago, a piece of land, for $200,000, and now you're selling it for $500,000. So it's gone up in value $300,000. You simply subtract that $200,000, which we call your basis, what you buy a property for is your beginning basis, and you simply subtract that from your $500,000 sale price. That's $300,000 of gain. And if you're in, let's say, a blended 25% tax bracket, because many people forget about the state income tax amount. So you add your capital gain federal amount to your state tax rate to come up with a blended rate. So again, in this example, I'm going to use 25% as the blended rate. So 25% of $300,000 of gain is $75,000 of tax. But many properties people own are not just land. They have a building on them, a structure on them. Usually it's rented out. The tax code allows you to take depreciation every year on that asset. And when you sell the property, you have to recapture that depreciation. Now you get the benefit of that depreciation each year on your tax return. Your CPA, your tax professional, is actually using that as a deduction against your income, so you are getting benefit. But again, there's payback, because when you sell, you have to recapture that depreciation. But that does affect your tax calculation. So let's go back to our example of buying a property for $200,000 and selling it for $500,000 after 10 years. If you've taken a $100,000 worth of depreciation over that 10-year period of time, your basis no longer stays your acquisition price of $200,000. It gets moved down. It gets lowered by that $100,000 that you've taken. So you subtract that $100,000 of depreciation from the $200,000 acquisition price to come up with your adjusted basis, which is now $100,000. You subtract now that $100,000 from the $500,000 sale price, and your gain will be $400,000. Now, calculating the tax on that $400,000 is a little more complicated because recapture of depreciation has a little bit different higher tax rate, which I won't go into right now. But I just wanted you to understand that if you buy a property and it doesn't go up in value a whole lot, you still may have a fairly high gain because you've taken depreciation over time. Understanding how to calculate your gain and your tax can be very helpful. At Atlanta Deferred Exchange, we help you maximize the benefit of your exchange transactions. Was it clear?
Yeah.
Okay.
Can you put those together?